In this video, I'm going to walk you through the secret sauce in terms of how to make money selling options. And we're going to do that via my Google scalping trade, which I'll walk you through. We'll go into my live account and I'll show you the gains I've made off this one trade. And again, what I want you to do is just take the principles that I'm sharing today and see how you can apply that into your trading when you sell options. Now, the main thing that you need to do is the old cliche of when you sell options, you want to sell an option at the highest possible option price and you want to buy it back at the lowest possible options price. Now, a lot of that is going to be dictated by the movement of the stock, but what's more important is the IV rank or the implied volatility rank of a stock. And you can see here for Google, this is the IV rank stock. And again, I'm on Tasty Trade. I'll leave a link down below. Just create a free account and you get access to all of this stuff. So it doesn't even cost you any money to do it. And they specialize in selling options and they've built tools, and the way that they've done things is really, really amazing to make it easy for you to make trading decisions, especially when you sell options. Now, going back to IV rank, and if you guys are brand new, implied volatility rank, what it does, it measures the current implied volatility of a stock over the past 52 weeks and then places the current implied volatility against those 52 weeks, and it spits out a number. So in this case, it's 26.8. The current implied volatility compared to the last 52 weeks of Google is sitting at 26.8. And you can see here we've had ridiculous numbers of over 100, and this was the kind of tariff situation. And what I want to focus on today is this little bump up in implied volatility here from the day before to about 28 to a high of 50. Now, when I trade options, or I'm looking for opportunities to trade, I'm looking for implied volatility to be greater than 30, or what's even better, over 30 and a massive spike up. And you can see here, this correlates with the price of where Google was down 7-8% on the day, and we see a rise in implied volatility. Now, the reason for that is, I think it was like Apple released news that they're integrating Apple Intelligence within the Safari browser. And again, you can see how that could be a negatively impact to Google and from their search engine perspective. However, I don't really care about that. What I care about is we've seen a massive increase, almost a double really, from 28 to 50 implied volatility in a day. And I think is a bit of an overreaction to the stock price. So I expected, and as you can see kind of here, a little bit of an increase or stay flat, not a full recovery, but I didn't expect it to continue to go down over the coming days. So that was my assumption, but what I had on my side was the implied volatility increasing with the hope at some point in the near future, implied volatility would decrease. And that's exactly what's happened there. So again, if you look at it from an options price perspective, when this price move happened and implied volatility went up, the option prices of Google in and around the current strike price for all expirations started to increase. So therefore, it was a good time for me then to say, okay, look, I want to get in, I want to get some of this action. I want to now start selling options on Google. And then when the implied volatility hopefully happens quick, and you can see here happen within 2 days of a move up and implied volatility declining, that's your best case scenario. Like, price could continue going down slowly and implied volatility could have slowly gone down. But what the point is when the implied volatility goes down and also you get a price move up in your favor, those option prices that have sold below and out the money when selling puts would have decreased dramatically. So let's go have a look at that now in my trading account. So in my trading account, there's a lot of stuff inside here, but the key things I want to show you is this Google June 20 130 put and Google 20 140 put. Now, again, I could have sold near-term options, as in weekly options or even a monthly option ending in the end of May. However, just in case things went wrong and Google continued to tank, I had time on my side for me to kind of eventually be right. And then that gives me enough time to roll positions, etc. So again, I'm always looking at the risk of these kind of positions. So I sold one contract, and my average price for the 130 put was 158, and the average price for the 140 put, that option that I sold, was 329. Now you can see here that just in 2 days, that 158 is now 79 cents, and that 329 is now $1.90. So you can see how much I've made in these two positions, and that as a percentage. So I'm roughly around over 50% on the 130 and near enough 45% on the 140. So with that being said, you guys know who watch me on my channel, I like to close positions early or when I get to 50% profit. 50% for an option that's like, 40 odd days out in 3 days, that's absolutely amazing. I'll take that and go recycle that margin that I've used to place these positions into other trades. And that's exactly what I've done here. And this is exactly what I think you guys should be doing or should be looking at, instead of doing your favorite stocks and things like that. Like, people will sell options on their favorite stocks, but for me, I've started to learn it's all about where the volatility is, and it may be in stocks that I've never heard of. As long as the stock is liquid, i.e. that there's a lot of contracts, a lot of volume, I can get in and out easy, bid-ask spread is quite low. The key thing for me is making sure if there's got high implied volatility, then I'll be looking to trade it. Now, in saying that, if you look here with the tariff situation where the implied volatility was like ridiculous, I've had a look at like the 140 option that I sold that is currently sitting at 79 during the time of the tariff. So in this area here, that option was priced at around $8. So it's gone from $8 to 90 odd cents, right? And I get it, these are tough times. Depending on if you're on margin or all these other different things, you may not want to put this trade on because you don't know where the bottom is. But again, this is something where even if you don't time it right at this peak, and let's just say you got in here, right, and it was $4, right, you can see eventually it goes down, similar to volatility with Bollinger Bands with standard deviation. We know that volatility goes up and volatility goes down. It goes up, it goes down. One thing is it doesn't stay high for that long, or if it does, it will eventually drop, which is why when you trade options or sell options, you want to pick the high volatility moments, but pick an expiration that gives you enough time, 45 to 60 days out. So just in case volatility continues to rise or the price continues to go down, then you have time on your side to eventually be right. And then you've got options of rolling the position, all these kind of advanced stuff there. But the key principle is when you open a selling option or selling put position, whether it's defined or undefined risk, you want to do it in high volatility environments. And hopefully this example has kind of shown you how that works. And I really hope you got a lot of value. Make sure you like and subscribe, and I shall see you guys in the next video.